Friday.
Friday.
It's been a while since we've chatted, so it's good to, and there's been stuff that's happened, so it's good to reconnect.
Yeah.
It's been just head down trying to get stuff out the door, but there have been a lot of things that have come out, and I'm having a hard time keeping up on stuff. So it's good to connect and talk about stuff.
Yeah, it is. It's definitely head down right now, and hope you're not making a mistake. Oh.
Thankfully, we've got good things in place to double and triple check things. So
for sure, absolutely.
I mean, one thing I know you sent me this link to info on Biden's family plan, and that seems to be, I'm getting a lot of inquiries from clients, so it's out there. And you and I have been talking about the tax implications of Biden coming into office for a while now, but it seemed a little more theoretical back in November, and now it's starting to be realistic. And so I've got a lot of clients asking about it. But before we talk about that,
well, I think if I can, I just say there's some new things on here that I had never heard of. I mean, we've talked about some of them, and I think you'll be interested in a couple of them too.
Yeah, I mean, it's the evolution of a campaign list coming into reality now. So things definitely change. But before we do, just really quickly, we should say one of the big things this week was California coming out with the info on the PPP loan.
Yes.
So we've got a lot of clients who have been on hold because of this, and now we've got final information. I'm hoping not every client is, all right, let's get these things filed, because I mean, the compression of work because of this delay from California is crazy.
Yeah.
But the bottom line is what we've been talking about and what we expected, because Newsom announced it, was $150,000 of expenses paid from forgiven PPP loans would be deductible. But that changed.
Yeah, it was, wildly different than what we expected and projected too.
Yeah, so now it's all or nothing. So you can deduct all your expenses spent with forgiven PPP loans, but only if you meet the criteria that the federal government, the SBA, set for the second round of PPP loans, which is a 25% reduction in gross receipts from 2019 to 2020 for any one calendar quarter in 2019. And I think for the year, but I'm not, you can compare it for the year, but I'm not totally clear on that.
Yeah, so it's definitely going to, for those businesses that were hit really hard, they will get not just 150, they'll get a full forgiveness.
Yeah, that's right.
And it's any one quarter too. At first I thought, okay, well, if it's one quarter, you get 25%, and every quarter, but it's not. It's like you said, it's all or nothing on that California forgiveness.
Right.
Well, and I should back up. It's not forgiveness of the loan, it's deductibility of expenses.
That's right.
Yeah.
Yeah. It's such double speak, right? I mean, it's always been, well, the forgiveness is not taxable. But then after a while, you learn, okay, yeah, well, we're not going to tax you on the forgiveness, but we're not going to let you deduct the expenses you spent from the loans or from the forgiven loans. Well, that's the same result as taxing the forgiveness,
Right, exactly.
It felt like a bit of a bait and switch.
Yeah.
Even unintended, albeit unintended, I think, but it did feel a bit like a bait and switch.
Yeah. It would have been interesting, if they wouldn't have forgiven the loans. In theory, I think you could have deferred it till next year, because if the debt was forgiven if the debt would have been forgiven in 2021, you would have picked up that income in 2021, which would then pay the tax probably in 2022, potentially. Whereas with this, it's all compressed back into 2020.
Yeah. Anyways, so we've got some closure on that finally.
The one thing, if I can, we were talking to a client, and the one thing we didn't see as a part of that was if you had the SBA pay some of your interest payments, I think it was 6 months of your loan payment under an SBA loan for Fed, that wasn't taxable. but for California it was, and we thought that maybe that would be included in that AB 80, but it wasn't.
Mm,
So that's still a taxable situation for California.
that's a different loan, obviously. That's not a PPP loan.
No, it was just if you
That's
had an SBA loan previously, they would pay 6 months of your
yeah,
loan.
yeah. Interesting. All right, so you want to move on to the
Yeah, I think it'd be good to talk about the family plan fact sheet.
and this came out what, last week?
It looks like it was April 28th. So no,
So a couple days ago.
a couple days ago. Yeah. Expanded ACA premium tax credits. So if you get health insurance through, the portals, it sounds like the American Family Plan would make those premium reductions permanent. So if you have clients that get those.
Great.
Increases in the child tax credit. So I think it's $2,000 per child. It goes up to $3,000 per child. And if the child is under 6, it's $3,600 per child. And it also bumps the age up that you can receive the tax credit up to age 17, up to 18. So before, once your kid hit 17, you no longer got that $2,000 credit. Now I think it makes 17-year-olds eligible for the first time.
Yep. Okay.
Increases in the dependent care credit. I don't really have a lot to say on that. I think the big ones, we did talk about these, would be the top brackets going up to 39.6%. So from 37% up to 39.6% for the highest income earners. The big one is, capital gains rates for those that are households making over $1 million. They would pay the same tax rate as they are on regular income. So that would jump from the 20% up to the 39.6%, plus your net investment income tax. So you're up in the 40s now.
Mm-hmm. Yeah, that's a big change. It's rates on ordinary income bouncing back and forth. We've seen that for a long, long time.
Yeah.
But changing the character of capital gain, like, basically removing the incentive to invest. That removes the incentive to invest. I mean, if you're a high income earner, and that aside, I guess to step back, Biden has said that nobody is going to see a tax increase if their income's under $400,000. So that's the context of all this discussion. But with that being said, high income earners will now lose the incentive to invest, right? If you can make ordinary income on wages, just as a wage earner, as opposed to investing in property or investing in a business or something like that, there's no incentive anymore if you're that high income earner.
Sure. Yeah.
So that's a pretty big change, I think, in philosophy.
Mm-hmm. There's some estate tax changes. I don't know if we've talked about this one, but reducing the step up in basis. So I think for gains in excess of $1 million, that step up would end unless property was donated to charity, which it doesn't really matter if it's donated to charity. So that's a pretty big thing.
And again, that's a philosophical change. So again, money and dollars aside, the philosophy behind allowing a step up in basis on inherited property is that it's already kind of run through the tax system.
Right.
So it would be unfair to not allow that step up in basis to then let the government tax that same gain a second time. So by eliminating this step up in basis, there are dollars involved, but the theory behind, okay, well, the government's going to tax this gain multiple times. That's a pretty aggressive change in philosophy, I think.
It doesn't say, and maybe I'm not reading this correctly, which happens all the time, but is it on per property or just the estate as a whole?
I think it's a step up in, I believe it's a step up in basis on inherited assets. So it would be each asset you inherit.
So if an asset was $900,000 of step up, you get it for $900,000 for each one, but the minute it goes over $1 million, each individual asset.
Oh, I see your question. I don't know that. I see that.
Yeah. So obviously we'll find out more as that goes along. I think the interesting thing about that, it kind of states in this article that family-owned businesses and farms would not have to pay taxes when given to their heirs who continue to run the business. So that's always been a really hard thing is families that run those businesses, and then all of a sudden they get hit with a huge estate tax because it's not a cash flow thing. You've got this asset, this factory that's working, and have to pay a huge estate tax. You don't have the cash flow for that. So that would be interesting to see how they're planning to allow that to escape. Ending carried interest. I know that's been talked about forever, and I know you have a personal research and done with that.
Yeah, it's not personal, but I have a lot of clients who, I guess the history is that big hedge fund managers take their compensation based on a portion of the return on those hedge funds. And because they get a portion of the gain, and the gain in the hedge fund is capital gains, they are paying capital gains rate on what really is their business, which is helping make money for these hedge funds. The problem is that applies also to what our clients, a good number of our clients do, which is real estate partnerships, put together a partnership with friends and families and go buy a commercial property, something like that. And the investors invest the money. The person who puts it together shares in the profit. Well, when the property sells, it's capital gain property. So they get that same capital gain treatment. Yeah. So if this change goes through, it'll impact our clients to treat that as ordinary gain and not capital gain.
Right. Yeah. And then the last one I saw that I was really interested in would be that the elimination of the like-kind exchange rule with respect to gains that are greater than $500,000 on real estate transactions. So
yeah,
that's a really big deal. We've seen the like-kind exchange rules change, over the since 2017 in the TCJA Act, where they, basically made it apply only to real estate. And now we're even seeing it kind of eliminated for gains that are over $500,000. So that'll be a big change.
Yeah, that's an interesting one too, because the philosophy behind 1031 exchange is that it's not a permanent thing, right? A 1031 exchange just defers the gain into the next property. So there is, of course, time value money on that, but the government gets their money eventually, unless a person holds that property until they die.
And I think the logic was always like, well, there was never, if you and I exchanged properties, there was no cash really. We just really you got a property and I got a property. And so it wasn't fair for necessarily the government to tax that. We were just exchanging one type of asset for another type that was worth the same.
Right.
I think.
Yeah, I agree. So, but nowadays, that's not the way exchanges are done, right?
Totally. I'm just saying originally, that's, I think, the logic behind why it wasn't taxable.
Yeah, you're right. It's a cashless transaction. So how is somebody going to come up with the cash for the tax when there was a cashless transaction?
Yeah.
Yeah, that's a very good point. I do think that the way it's done these days with an accommodator that allows you to go basically buy another property and roll your
Right.
gain to the next property does help, like on the capital gains rates, it stimulates investment,
Mm-hmm.
so it'll be interesting to see. I know that there's a lot, I see it all the time. There's a lot of transactions that the main motivation of which is to satisfy a 1031 exchange.
Yeah.
So there will be a drop in demand if this goes through. I mean, so that will impact. Who knows how much? Certainly, I'm not an expert, but it would impact the real estate market, I'm sure.
Yeah.
Anyways, yeah, that there are a couple of new things in there that are interesting to note that I'm sure people will be interested in.
Yep.
All right, I know you need to go to your daughter's soccer game.
Soccer, and then watch the Seattle Mariners play
The
some
Angels.
baseball tonight.
Are you going to the game?
No.
It's
Is it
here, right?
I don't know. No, I think it's in Seattle.
Oh, it is? Okay.
Yeah. So, all right. Well,
and our Angels and Mariners are like essentially tied.
Yeah. I think the AL West in general is pretty bunched up.
Yeah. It's early.
It is.
It's a marathon, Steve, not a sprint.
Not a sprint, but as long as we win tonight, that's all that matters. All right. Bye.
See ya.